What if the exact same strategies that, made a company a billion-dollar success just 3 years ago are the precise reasons they'll go bankrupt tomorrow?
Right. It's a terrifying thought.
Welcome to your deep dive. Today we're taking a really hard look at the landscape you are operating in right now. And to kick things off, I want to describe an image from our sources that perfectly captures this brutal transition we're all living through.
Yeah, it's a very stark visual.
It really is. Picture this gloomy, abandoned corporate boardroom. And on the floor lies a unicorn horn, but it's completely shattered into these jagged, glass-like pieces.
And right behind it, there's this massive stock chart just violently crashing downward into the red.
Exactly. But then the image splits. On the right side, you're suddenly in this sweeping, sunlit desert landscape. And striding right through the sand, looking incredibly confident, is a camel.
A camel. Yeah.
Right, and behind that camel, a golden graph is just soaring upwards. And right across the center of this whole picture, in bold text, it says, "Hype is no longer a currency. EBITDA is the only North Star."
Which is, quite the statement. What we're really looking at here is the autopsy of one economic era and the very necessary, very painful birth of another.
And that is exactly our mission for this deep dive. We are unpacking a fascinating analytical manifesto we received. It's titled The Era of the Camel: How the End of Free Money and Operating Leverage Are Rewriting the Anatomy of Global Business.
It's a heavy title, but so crucial.
It is. So our goal today is to explore why the global business landscape is suddenly trading in its mythical creatures for beasts of burden, basically. We want to understand how this massive macroeconomic shift is completely redefining what a successful company actually looks like.
Right, and it's a vital exploration for anyone listening because, well, the metrics you used to judge your own success just a few years ago are likely the exact things that will sink your operations today.
Yeah. So let's unpack that bold text from the image first. That EBITDA is the only North Star thing. For anyone who isn't, living in financial statements all day, EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
Right, the classic accountant alphabet soup.
Basically, it's the unfiltered, hard truth of the actual operating cash your core business generates before the accountants get their hands on it. So why is that suddenly the only thing that matters?
Well, to understand that, you really have to look at the macroeconomic trigger that caused all that glass to break in the first place. Think of the last decade as this massive, roaring, growth-at-any-cost party.
Like capital was incredibly cheap.
Almost free. This was the zero interest rate policy era, or ZIRP. But then central banks walked into the room and just flipped on the harsh fluorescent lights with a series of really dry clinical rate hikes.
The party's over, right? And capital suddenly has a very real price tag again.
Exactly. What's fascinating here is the realization that the old corporate landscape wasn't actually a sustainable business environment at all. It was, as the manifesto so perfectly puts it, a narrative subsidized by investors.
Wow, a narrative subsidized by investors.
Yeah, because when money is free, you don't actually have to prove your business model generates real cash. You just have to prove your story is exciting enough to attract the next round of venture funding.
Right, it was entirely about the pitch deck, not the profit.
Nah.
The source actually points out that during that ZIRP era, scale was measured by these ridiculous vanity metrics.
Oh, absolutely.
It was measured by, like, the square footage of your open plan office in downtown San Francisco, or how many full-time baristas you had on your corporate floors making flat whites for the marketing team.
Right, but when the cost of borrowing what finance folks call WACC, or the weighted average cost of capital, when that spikes, that entire illusion just collapses. You can't rely on cheap debt to keep the lights on while you figure out how to be profitable someday.
Right.
You have to rely on real operating margins, and that's why the unicorn is dead. These lumbering, bloated corporate structures are collapsing under their own weight because they were literally never designed to survive a drought.
And in its place, we have the camel. The market has a new apex predator. And camels aren't glamorous, right? They don't have a magical horn.
No, definitely not.
But they're engineered for high survivability. They're built for a world with an extreme cost of capital.
Okay, let's unpack this. Because it's really easy to sit here and say, hey, just be a camel, survive the desert, focus on EBITDA.
Much easier said than done.
Right. Practically speaking, how do companies actually adapt to zero water when they've literally spent the last decade drinking from a fire hose? If you're accustomed to endless spending, how do you just magically pivot to ruthless efficiency overnight without totally destroying your product?
Well, that's the core dilemma. And to answer it, we have to look at the mechanical changes in how products are actually built today versus just 3 years ago. The fundamental rules of development have changed entirely because the technological barrier to entry has undergone a massive devaluation.
You're talking about the AI tooling. I am, yeah. The source explains that by integrating AI tooling and LLM orchestration, large language model orchestration, the entire cost structure of product creation has just been rewritten. We are talking about the time to market for a minimum viable product being slashed by 40 to 60%.
Wait, 40 to 60%, but how? Is that, I mean, we all know AI can write code, but writing code and shipping a stable commercial product
Right.
are two very different things.
Yeah, and it's not just about an AI spitting out a Python script. It's about LLM orchestration handling the entire connective tissue of software development.
What does that look like in practice?
While these tools are automating the boilerplate, they're stringing together complex microservices, running automated quality assurance testing, and handling deployment protocols. What used to require a fleet of 50 software engineers building everything from scratch can now be executed by a lean strike team of system architects.
Hold on, you're saying a 3-person team can replace a 50-person engineering department just by orchestrating AI tools? I really have to push back on that.
Sure.
Doesn't stripping out that much human oversight just lead to a massive accumulation of errors? If you're trusting AI to build the architecture, how is a tiny, lean team actually maintaining quality control and security for like an enterprise-level product?
It's a fair question, but it fundamentally misunderstands where the value in software actually lies in 2026. The text points out that raw code is now just a commodity. The AI isn't building the high-level architecture.
Oh, the human is.
Exactly, the human system architect is.
Hmm.
The lean team designs the flawless logical blueprint, and the AI executes the repetitive manual coding labor to build it. Because the human team isn't bogged down in writing thousands of lines of syntax, they can actually dedicate their time entirely to quality control, security, and strategic alignment.
Oh, I see. Here's where it gets really interesting. It's like we used to pay an absolute fortune for the bricks and the bricklayers. We had to hire 50 bricklayers to slowly build the wall, and human error meant the wall was often crooked. But today, the bricks basically lay themselves. So now, we're only paying for the master architect's blueprint. We just need the person who knows exactly where the wall should go to stop the wind.
That's a perfect analogy. You're no longer paying for the manual labor of construction, you're paying for the strategic vision. And from a financial perspective, this drastically reduces a company's capital expenditure, or CapEx.
Because you aren't buying massive servers or hiring huge teams up front.
Exactly. Furthermore, it completely eliminates bureaucratic technical debt. When you have a lean team using automated tools, you don't build up layers of messy, overly complex legacy systems where nobody even remembers how the old code works.
So you're nimble. You can pivot a product feature over a weekend without having to ask a committee of 50 people to rewrite their specific block of code.
Precisely. Small teams have suddenly become vastly more economically efficient than massive corporations because they're completely unburdened by that legacy weight.
Which brings up a massive point of friction that I think a lot of you listening might be wrestling with. If the cost to build a product has plummeted this drastically, why is Wall Street suddenly demanding completely different, much harsher financial metrics from these companies?
Yeah, you'd think they would relax.
Right. I mean, if it's vastly cheaper to run a business today, shouldn't institutional investors be, thrilled?
You'd think so, but it's actually the opposite. Because the era of financial engineering is dead. Investors know it's cheaper to build, so they're stripping away all the financial gymnastics and demanding to see the actual cash.
Okay, that makes sense. The manifesto gets into some highly specific regulatory changes that are forcing this issue. It points to new taxes on stock buybacks, specifically a 1% tax in the US and a 2% tax in Canada.
Right.
Now, to a savvy listener, a 1% tax sounds like a rounding error for a multi-billion-dollar corporation. Why does that specifically break the game?
If we connect this to the bigger picture, you have to think about how the game was played during the ZIRP era. Corporate boards use stock buybacks as a primary mechanism to artificially inflate their EPS, their earnings per share.
Oh, okay.
When interest rates were near zero, a company could literally borrow free money, use that debt to buy back its own stock, reduce the number of outstanding shares, and boom, their earnings per share looked fantastic on paper.
Even if the actual business hadn't grown an inch, and that triggers massive executive bonuses.
Exactly.
It's a complete illusion. You're just changing the denominator.
Exactly. But here's why that 1 or 2% tax breaks it. When you combine that new tax friction with the fact that WACC, the cost of borrowing that money, is now sitting at 5, 6, or 7%, the math on the arbitrage completely inverts.
Wow. So it's not free anymore.
No, that trick is suddenly incredibly expensive. It breaks the incentive structure for the board entirely. They can't hide behind manipulated EPS anymore.
So if EPS is out, and you can't financially engineer your way to a good quarter, what's the new metric? The source says investor attention has forcefully pivoted to operating margin and free cash flow. FCF.
Because, as we established earlier, cash is oxygen in the desert.
Yeah.
You cannot fake free cash flow. You either have the actual liquid money in the bank at the end of the month after paying your expenses, or you don't.
Right.
The narrative-driven bubbles, where a charismatic CEO promises profitability 10 years down the line, those are being aggressively replaced by the cold, unforgiving reality of unit economics.
Like, does it cost you more to acquire a customer than that customer pays you?
Exactly.
And if the answer is yes, the market no longer cares about your user growth rate. You're a bleeding unicorn, and you're going to die in the desert.
Brutal, but true.
Okay, but let's bring this closer to home. This isn't just a story about Wall Street hedge funds and giant public tech companies. If you're listening to this and you run a regional agency or a mid-sized logistics firm, this macroeconomic realignment sweeps all the way down to Main Street.
Absolutely it does.
It fundamentally changes the game for everyday small and medium businesses, the SMBs.
The manifesto actually makes a crucial pivot here to view this from what it calls Main Street new rules for the artisans.
And it introduces this concept that I think every single person listening to this will relate to on a visceral level. Look at your own daily workflows right now. The source calls it the chaos tax.
Ah, the chaos tax.
Yes, the chaos tax is the hidden leakage of capital through unoptimized processes.
It's basically the friction of doing business poorly.
Exactly.
Yeah.
The source gives these amazing, painful examples. Think about an immigration consultant who loses 30% of their entire day just hunting through fragmented email chains, cross-referencing PDFs, and doing manual data entry.
We've all been there.
Or imagine a construction boss who signs multi-million-dollar contracts but literally has to wait 3 weeks after the quarter ends just to see their actual operating profit, simply because their accountant is buried alive in piles of Excel sheets trying to reconcile vendor invoices.
That delay, that inefficiency, that is the chaos tax. And in the era of the camel, this tax devours the very operating margins that are required for survival.
Right.
I mean, if the market is demanding proof of life through free cash flow, you just cannot afford to leak 30% of your productivity to bad email management or manual invoicing.
But the flip side is that this exact pressure is creating a massive opportunity. The source calls it the renaissance of micro-multinationals or high-tech SMBs.
Because small no longer means weak. Small no longer means local.
Exactly. The collapse of the corporate Goliaths, the ones bogged down by legacy tech and bloated payrolls, is actually releasing oxygen for leaner players. A small business today, if properly architected, is frictionless.
Complete frictionless.
Like if something in the global supply chain changes, a micro-multinational can reconfigure its entire software architecture over a weekend. A giant corporation has to form a steering committee that meets for 6 months just to authorize changing a vendor.
And to build these defensible moats, these high-tech SMBs are relying on entirely new infrastructure. The source details 2 specific ecosystems that are facilitating this shift. First, there's LFBOSS, which is described as a vertical FinOps platform.
Financial operations. Now, how does that actually cure the chaos tax for a small business?
What's brilliant about LFBOSS is how it structurally aligns with the Camel mindset. It operates on a revenue share model rather than some massive upfront licensing fee.
Oh, nice. So there's zero CapEx for integration.
Zero. You don't pay millions to a consulting firm to set it up over a year. Their infrastructure just plugs in and automatically manages the entire mechanics of your transactions, invoicing, and compliance through Stripe Connect.
Wow.
It routes the money, reconciles the ledgers in real time, and handles the tax compliance automatically. It eliminates the chaos tax of financial management entirely, meaning that construction boss sees their operating profit the second a contract is signed, not 3 weeks later.
That's massive. And the second ecosystem that Manifesto digs into is called LadyBOSS, which is described as an operational system for leadership.
Yes.
Now, I love how the source phrases this, but I also need you to decode it for me. It says LadyBOSS digitizes empathy. It translates corporate culture into the harsh language of unit economics. Give me the mechanics on that. How do you actually digitize empathy without it just being some creepy corporate surveillance tool?
It sounds like a paradox, doesn't it? But it's incredibly practical when you look at the math. In a lean team, burnout is catastrophic.
Right, if you only have 3 people.
Exactly. If you only have 3 system architects and 1 quits because of a toxic culture, you just lost 33% of your production capacity overnight. LadyBOSS provides operational frameworks that map employee sentiment and workflow bottlenecks directly to financial metrics.
So it's about proving that treating people well actually makes you money.
Precisely. High corporate culture isn't just a nice-to-have HR initiative anymore, it's a financial moat. By systematically tracking and improving team alignment, It lowers your churn rate, meaning fewer employees or customers leave.
Which is huge for the bottom line.
Huge. Because your team is stable and highly engaged, it dramatically lowers your CAC, your customer acquisition cost, and it drives steady growth in LTV, the lifetime value of the client, because the client is interacting with a consistent, happy, high-performing team.
Wow.
Ladyball SS turns those soft leadership skills into measurable, defensible financial infrastructure.
So what does this all mean for how we define a company's size today? Are we completely throwing out the old dictionary? Because traditionally, if I asked you how big a company was, the very easiest thing you tell me is how many people work there.
We're absolutely throwing out the old dictionary. The manifesto is explicit about this in its conclusion. The old way of measuring scale employee headcount, how many floors you occupy in a Class A office tower in downtown Manhattan, the sheer geography of your bank branches.
Yep.
All of that is now considered toxic.
Toxic?
Yeah.
Not just outdated, but actively harmful to the company's valuation.
Correct. Because headcount is no longer a measure of capability, it's a measure of overhead. The new absolute yardstick for a business is its operating leverage and its transactional density per team member.
Like, how much revenue can a single human being safely and sustainably manage when backed by the right AI infrastructure?
Exactly. The source gives this mind-bending comparison that really cements this idea for anyone trying to gauge their own company's health. It lays out a scenario with two different companies. Company A is a tiny 3-person team, but because they're using automated infrastructure, LLM orchestration, and robust retention systems like that LFBOSS and Ladyboss paradigm we just talked about, this tiny trio is generating $5 million in annual revenue.
That's incredible.
And under the new definitions, because of their massive influence, their low capex, and their absolute capital stability, that 3-person team is officially classified as a highly stable, medium-sized business.
Now look at Company B. Company B is a 100-person firm. They also make $5 million in annual revenue. But they're bleeding profit out of every pore to cover the chaos tax.
Right, they have layers of middle management.
Massive HR overhead, manual data entry teams, and a massive payroll to meet every 2 weeks.
In stark contrast to the 3-person team, that 100-person firm has degraded into a micro-enterprise teetering on the edge of survival.
Even though they make the exact same top-line revenue.
Yes, because their operating leverage is terrible. They have no free cash flow. They're literally one bad quarter or one slight bump in interest rates away from total collapse.
It fundamentally flips our entire understanding of scale. The winner in 2026 isn't the company who writes the code first, or hires the most engineers, or rents the biggest office.
Right.
The winner is the company whose OPEX, their operating expenses, approaches zero, while simultaneously maintaining high switching costs for their clients so they don't leave.
The future belongs to flawless operating code. It's about transforming every single workflow, every transaction, every customer interaction into an automated, highly efficient system where every dollar spent generates maximum added value rather than just keeping the lights on.
So to pull all these threads together for you listening right now, we are living through a monumental, irreversible shift. We've watched the hyped-up, growth-at-any-cost unicorns die out, replaced by high survivability camels who worship at the altar of EBITDA.
Right.
We're seeing expensive, manual raw code being replaced by incredibly lean, AI-driven architectural blueprints. And on Wall Street, the days of artificially manipulating EPS with debt-fueled stock buybacks are over. It's all about cold, hard, free cash flow.
And for you on Main Street, it means that small is no longer a disadvantage.
Small is a superpower.
Yeah.
But only, and this is the crucial caveat you need to take away from this, only provided you completely eradicate the chaos tax from your own workflows. If you're looking at your own company's software stack right now and realizing it's held together by fragmented email chains, Excel spreadsheets, and sheer human willpower, the desert is going to be very, very dry for you.
This raises an important question, though.
Yeah.
The source material proves, without a doubt, that businesses must adopt this flawless operating code to survive. We discussed how a project that used to take 50 engineers is now done by a tiny strike team of 3.
Right.
But if a 3-person team is the new ideal for a $5 million company, what happens to the broader global workforce when an entire generation of legacy companies wakes up and realizes that hiring 100 people to do the job of 3 isn't just inefficient, but fundamentally toxic to their survival?
Yeah. Oh, wow.
Where do those other 97 people go?
Wow. That's the uncomfortable shadow behind all this incredible efficiency. Something for you to deeply mull over as you look at your own industry, your own skill sets, and your own team this week. Thank you so much for joining us on this deep dive. As you head back out into the world, remember that shattered glass on the boardroom floor. The era of free money magic is gone. But if you can adapt, if you can build for the heat and ruthlessly focus on the mechanics, the desert is wide open. We'll catch you on the next one.